Big tech earnings have begun, and is it a sign of things to come with Netflix coming underneath that Q3 guidance, sending shares of the streaming giant down about 1.8% in the after hours? We'll discuss that and more. What is going on, investors? Hopefully, guys are doing well out there. Folks, we've got Q2 numbers from Netflix coming out after the bell on today's show. We'll talk about the Q2 numbers, talk about the Q3 guide as well, talk about how that came underneath expectations, putting some selling pressure on the stock. We'll take a look at the high-level numbers. We'll jump into the different regions that we always talk about when we talk about Netflix. We'll come over here and look at the numbers a little more closely, revenues, profits, cash flow, what they're going to do with all the cash that they're generating from their business over at Netflix. And then we'll come over here and look at this technically. It is bouncing around in the after hours, down about 1.5, 1.6%. And like a lot of tech stocks, really retreating over the past week or so as we've seen a rotation out of these kind of high growth, high valuation tech stocks and moving more into maybe some of your broader based stocks. We'll talk about if that will continue as well. So Netflix year to date, up huge, up 32%. Over the last year, up 43%. But over the past month, down about 5%. And we're seeing over the past 5 days as that rotation continues, down about 2.5%. Revenue in the most recent quarter coming in at that $9.6 billion. We'll go through that number more in depth here in a minute, show you the incredible scale that Netflix is generating, all these operating profits. When we get to cash flow, we'll show you companies generating a lot of cash as well. They don't got a lot of places to put it. So that brings in some opportunity going forward, particularly as we start to look that the Q3 guidance and maybe subsequent guidance in further quarters is showing that we're going to see a slowdown in growth. Now, the company said their Q3 revenue is going to be at $9.7 billion. The estimate, unfortunately, was closer to $9.81 billion. The high-end estimate on Wall Street was closer to $10 billion. Now, the company puts up these revenue numbers, as you know, and they're putting up kind of what could be referred to as kind of a sandbagging number. Now, they beat the most recent number by about $30 million. That's not a lot when we're talking about $9.56 billion worth of revenue. So if they only beat this number by a little bit, 9.7, maybe upside to $9.8 billion in revenue, and you're just meeting expectations of about 15% growth, brings into question into Q4, Q1 into next year, and those types of things, kind of this low teens growth. Are they going to be able to maintain that over at Netflix? That's certainly a question that analysts are going to be asking. Now, what's been impressive over at Netflix is their year-over-year growth, not only on the revenue side, but their operating margins, the profit that they make from 22.3% all the way up to 27.2%, and that's going to follow through in the upcoming quarter as well to 28.1%. Very Tesla-like. If you look at Tesla's numbers, which we'll look at, I think, next week, this is an electric vehicle company that is in a sector where basically no other electric vehicle maker makes any money. And when we look at the streaming business, it's actually very similar. There's not really a lot of other streamers making money. And Netflix just continues to do that, and they're expanding their margin. Gives them a very, very solid position, at least in the sector that they dominate. It's leading to huge EPS growth over the last year from $3.29 up to $4.88 a share, now up to $5.10 forecast for the Q3. When you look at the different regions, it's pretty well diversified, but I think what we're starting to see is kind of that year-over-year growth in terms of subs. Also, how much they can increase the price here at home on Netflix. This is United States and Canada, growing just 7% year over year. But we're even seeing sequentially quarter over quarter, $17.30 down to $17.17, although that is still higher than the $16 that they were able to charge last year. But we're seeing that paid net addition number start to shrink, at least over the last couple of quarters. Same thing in Europe, just not able to charge much more than about $11 per month for the subscription of Netflix, but it's still driving strong net paid additions. And I think they've completely run up against how much they can charge in the other regions. Latin America in particular, down 3% year over year from about $8.60 down to about $8.30. Asia Pacific as well, $7.66 down to $7.17. But you offset that obviously with more and more people willing to pay that subscription fee. So Netflix has some things that they need to work on. We'll talk about some of the content side that they're working on, at least in terms of cash flows. But let's jump into these numbers. $9.6 billion. Last quarter, it was 9.4. Last year, it was $8.2 billion. What we're seeing over at Netflix is really, really good scale from this company. We're not seeing a big ballooning in their cost of revenue, even in this inflationary environment. It's more of a service. I know they have to pay people and produce content and those types of things, but we're not seeing that massive increase maybe on a cost of goods sites that you might see at a grocer or certainly like a Nike or something like that. Marketing, really impressive here. $630 last year, up just fractionally really to $644 last quarter. It was $654. Continuing to invest in technology and development, particularly on the ad tech side. They're going to have a self-service ad tech that is going to roll out, I think, in Canada and to broader markets. That should spur that ad segment at Netflix from $657 up to $711. And you've got your G&A basically staying relatively flat or growing in relation to our revenue. Our operating income, really strong, $2.6 billion, basically flat quarter over quarter. I think you could start to annualize this number out. Last year, you were closer to $1.8 billion. Net income, $2.1 billion. Last quarter, 2.3, 1.5 last year. It's giving this company a really solid financial footing. They've got a lot of cash and cash equivalents, $6.6 billion. I know it's not Google-like or Apple-like, but we're not talking about $1 trillion company. We're talking about a company worth about $280 billion. They've offset that a little bit with their long-term debt, but they continue to reinvest this cash and reinvest the cash flows into content. We're seeing them move more into live events. They've got NFL games coming up later this year. That'll be in Q4. Be interesting to see how that performs. They've got a Joe Rogan event. If Mike Tyson is healthy enough, that'll be an interesting event for Netflix later this fall as well. Some people are saying the traditional programming on Netflix is getting a little bit stale, but the company is transitioning a little bit. They have that Tom Brady roast and those types of things, these one-off and these live and these comedies and even live sports, maybe replacing some of the mega hits that the company has been known to produce. Now, net income, $2.2 billion, 2.3 last quarter. Flow through all of the operating cash flow. You're producing $1.3 billion, somewhat of a disappointment based on last year and certainly last quarter, but this company doesn't have a lot to spend this money on. Notice purchase of property, plant, and equipment. They're not like a chip manufacturer or something like that where they got to build these big facilities to manufacture something. They don't got to do that. So they barely spend anything here. So most of your cash flow is actually going back and repurchasing the stock. So as we start to look at Netflix, maybe looking, at least in the shorter term, a little more mature from its growth rate perspective, going from high teens to mid to low teens, maybe even high single-digit growth rate on that revenue, they're still going to generate enough cash flow to buy back the shares if they want to do that. Obviously, they can do an acquisition if that is something that interests them. And that's something to keep an eye on as we move into this political season where you could have a changing of the guard in Washington and maybe a change in policy as it relates to big tech companies acquiring assets with their cash flow and their cash on hand. Now, Netflix technical chart still looks really good. Okay, we made some highs. If you watch our Fang Stock recap show, we've kind of targeted this area up here. We'll call it about $700 per share. Thought we'd had a destiny to kind of touch it, and that's exactly what we did. Weren't really sure what the revenue and the profits had to be on earnings to really blast us up over that. Tell you what, you got to blast up over 700 on Netflix, and it's look out above. You're probably hitting 750, 775 in very short order. But we got rejected there, which is really no big deal. You're still making a series of higher highs, which dates all the way back to 2022 on this one. You're looking to buy the dip. There's great opportunities anywhere south of about $600 absolutely would be a great spot. Further down, there should be some really firm support down here at about $550. You're looking to buy the dip on Netflix, and certainly if this one continues to walk its way back, I'll probably add a small position to my portfolio. Guys, that was the start of earnings season with the technology companies. I look forward to being back on Friday for the Fang Stock Recap Show. Until then, good luck with your investments.